Um, this final business, Luke, is Elders. A lot of people would know this, trades under the ticker symbol ELD. They've been around the country. They see the signs for real estate, for whatever, fertilizers, and every farmer will know them. The business is kind of divided up, as far as we're kind of into like three main divisions. But can you just give us kind of like the 101 of what Elders is and maybe just how it's changed over the years? I think that's the real important part.
Yeah, so you got to think about Elders was a basket case.
Yeah.
And then it got new management 4 years ago or so, and now it's fixed. It's kind of the net. And Elders have another business with 25 or 30% market share of what they do, and have the cheapest cost of capital, essentially, of them and Nutrien. They're sort of their major competitor from overseas, which is NTR. I think the code for that is in the US. They're sort of running the show here in Australia from a fertilizer distribution perspective, fertilizer sales. Elders are kind of doing what, if you followed Kogan or My Deal when they were listed, is you build a marketplace of established brands, and then you slot your private label product in there and you cannibalize everyone else's sales. And that's pretty much what Elders are doing. And as a result, their margins are amazing. Sure, fertilizer prices have gone bananas, DAP, MAP's gone nuts, ammonia's gone nuts, but we'll sort of put that to the side. You can kind of, normalize out for that. If you do that, you'll find Elders is a business that's expanding its margins, that's growing kind of 20% plus per annum. They've got what I love about them is, okay, they've got access to capital. They go and make these small acquisitions, bolt-ons, expand, get the private label in there in these farms and grow their sales. But they're super disciplined what they buy. They've got like a 20% IRR hurdle in place for those acquisitions, and they pretty much just, if they're not willing to pay that price, then they're not interested. So that kind of keeps their returns pretty good, and their growth really high quality growth. I'm not a huge fan of sort of roll up stories, but Elders I more think of as expanding distribution. It's not really like, we're just adding their sales. What they're doing is they're adding the sales initially, but then flipping the margins. The margins go from 5 to 15 or 20% because of the increasing sales and product they can push through those farms. In my industry, to be the same as acquiring a client from someone who's retiring and then selling them mortgage broking and selling them general insurance and selling them whatever else that we do. So it's the multi-product, single relationship, trusted point of contact for a farmer. And I think Elders has that brand gravitas, that established position in the market. The various partners and employees have deep roots into the communities that they operate in, as a general comment. And as a result, I don't really see a reason why Elders can't continue to ride the kind of agricultural food sort of undercurrent and structural growth trend, while extracting above industry kind of margins and growth rates through their dominant market position. So love it for the market position, and like from a Val perspective, I think like $12 it's pretty cheap on sort of an EV to EBITDA basis on my numbers. And if you go out 2 years, it starts to look pretty naughty, which is kind of one of my favorite things to do for some of these larger cap businesses, is rather than just trying to play the next result or the next two results, think, okay, where's this business probably going to be in three or 4 years? And if the earnings, if they've been able to grow at this rate, let's create a margin of safety and say they're going to grow at Y rate, a bit lower, and they just keep their margins stable. What's it look like? And that kind of gives you some sort of idea of, where it might be. And I think for a business like Elders, it could be a multiple of the current share price. Actually, it's actually got a lot of upside potential. Everything going to plan.
Yeah. How do you think things like the cyclical effects of things like drought, all that sort of stuff affect the business?
I think that's the opportunity. The opportunity is to say, okay, FY22 is going to be a bit busted up because of the rain. But I kind of think it's like mining prices or anything that's cyclical. It's not really where we like to play. And even if we are playing, it's not the reason we want to be there is because we think the price of something's going to go up. Higher fertilizer prices help elders, no doubt, but they're over earning right now. Like, I think they're 27%. Like they've got pretty good numbers at the moment. So don't pay for those numbers to be in perpetuity. Go look at the bottom of the cycle. Go look at what it's going to look like on the worst day. Figure out what you think a fair price to pay for it is on the worst day. And sure enough, you'll get a best day at some point over your holding period. And, not necessarily that you're going to sell or you're going to pick that day or you're going to be able to, work those cycles out perfectly. I can't predict the weather. I don't know what the iron ore price is going to be. I don't know what the AUD, USD is going to be on any given day at any given point in the future. So they're not knowable things. And even if you think you can know, do it 100 times and you won't get it right, more than 50. So I think that's a big part of investing as well, is just understanding what you can't know and what you won't know, and just making sure that you get paid for that. And I think having a margin of safety when things go wrong helps you. You still lose money. Still, it's still wrong. You still get smoked a bit, but you might not get smoked as bad as someone who thought, well, what if this goes right and this goes right and this goes right? Then it's going to be super cheap and I'm going to make a heap of money. And that means missing out on things sometimes, and that's okay. But with elders, this kind of $11, like you've kind of got $3 or $4 of short-term kind of upside, 12 months sort of, price targety type stuff, but you've got another $5 to $10 a share worth of potential value there that might get unlocked over the next sort of 4 to 10 years, depending on what you think. And if that's the case, maybe I do a doubles over 8 years. Well, it's 10% per annum kind of thing. So that's a pretty good get. And like I said, if they can sustain the kind of return on equity they've been running, even if it's 15% per annum CAGR into perpetuities, about as good as you're going to get in large cap investing. That suits me down to a T. That can go in the portfolio at 5%, and I can park it there and pretty much forget about it. And then people will wonder why we outperformed. It's like, well, that wasn't that hard, was it? Seriously, like it doesn't have to be that hard.